Hello everyone and welcome back to TradingView Snaps. My name is Tagatha and I'm here to take you through some of the highs and lows of what has been going on in the market so far this week. We are going to kick things off with a weekly heat map, which don't want to scare you or anything, but is looking pretty terrifying. This is probably the worst weekly heat map we've seen in a good 6 or so weeks in these little weekly updates that we do. Major US indices had a pretty, melancholy Monday and saw sharp reversals from last week's gains. If we slide this down to a monthly heat map, things are looking a little bit more promising, but honestly, a lot worse than they were the last couple of weeks as well. There were many a hope for a August in the green after July was such a stellar month for the market. Alas, it looks like the bulls may be back in the pen for August. Perhaps September will be their month. If we take a look at the major US indices, you can see here we've got the S&P, the NASDAQ, the Dow Jones and the Russell. All four of those ended both Monday and Tuesday with losses. However, as you can see, it is Wednesday morning. Markets opened about an hour and a half ago, and as you can see, we are experiencing a little bit of a recovery, but wouldn't hold your breath because there was PMI data, I keep saying PCE data, PMI data that came out earlier this week that basically, in a nutshell, tracks the services and manufacturing sector in the US and showed that that sector is weakening. Or did weaken rather in July. That is the second month that it's weakened, and essentially that means that business activity in the private sector is slowing. Now, for the private sector, of course, and the economy itself, that's not great news. It means that the economy is getting weaker. However, for the Fed, who is largely trying to weaken the economy in a sense to tame inflation, this is actually kind of exactly what they wanted to see. However, major US indices all reversed. If we take a look at how the dollar is doing, on that news, you can see that the dollar has been absolutely soaring the last couple of sessions. On Monday, it actually hit its highest level in 20 years, since 2002. The euro dropped below parity with the dollar for the first time pretty much since its creation in 2002. This PMI data was felt sort of across the board. Everybody is now waiting basically for Jackson Hole, which is a conference that happens, the shortened name is Jackson Hole, it happens in Jackson Hole, Wyoming, and it basically sees a ton of economists, policymakers, regulators all meet in one place and have a massive chinwag about the state of the economy and see what they're going to do. It's a big deal because all of these important people are gathering in one place, and it's kind of developed a history of being a time at which big announcements are made. It'll also be the first time that this has been held in person since COVID started, so it's likely to be a big one. Everybody keep an eye out for Friday's news. We have got some data from Reuters, I never know how to say that, Reuters economists, who have weighed in on where they think inflation will sit, where September's rate hike will come in. The general chat is for a 0.5 or 0.50 percentage hike. That will be slightly slower than we had in July and June. Both of those were 75 basis point hikes, but there have been signs that the economy is weakening, and the Fed had said in its July meeting that if it sees the data to support it slowing down its rate hikes, that it would. So at the moment, a lot of economists are predicting a 50 basis point hike. Obviously, I've said this before and I'll say it again, all of this is largely just conjecture at this point. There is a lot of guessing and gambling going on as to what the Fed is going to do. Nobody truly knows. However, Jackson Hole on Friday will definitely give us a little bit more insight into what their decision is going to be. On the plus side, economists are saying that if there is a recession, it's going to be a short one and a shallow one, much like my bank account after paying this month's electricity bill. And also, actually, now that we're on the topic, much like AMC's market cap right now. So this brings us to the first story of the day. AMC on Monday released the special dividend of preferred equity units, which were trading under the ticker APE, obviously as a nod to its APE investors that sent its stocks soaring all those years ago. Well, actually, it wasn't that long ago, but a lot's happened, I think we can all agree. So these dividends were actually meant to be released on Friday. There was much speculation, as you can imagine, online about why they weren't deposited into investors' accounts. But anyway, they arrived Monday, and as you can see by this rather red candle, actually did not do too well. They opened up at $6.95 and soared higher than $10 before they had to halt trading in afternoon trading for a while, and it eventually closed down at $6. However, good news is that it's actually been on the up and up the last couple of days. So it's looking like they may in fact be some value to these. For anyone who is not aware of what the whole APE preferred dividend thing is all about, AMC has basically issued the special dividend to its investors. So it kind of acts similar to a 2-for-1 stock split. So for every 1 share of AMC you have, you're going to get 1 share of this APE dividend. In a way, it's kind of, not in a way, it is essentially for AMC to be able to raise cash whenever they like. However, there is some debate as to whether this will actually be good for AMC and its actual common stock. They think that, well, I say they, analysts think that could lead to share dilution, and obviously investors agree, because if we take a look at this chart, we can slide a little bit back to last week where you can see there was a little bit of a rally when the retail traders came to town. However, it dropped over 40% on Monday and has continued to go down. It's now over just under 50% for the week. There were other factors at play, one of which was the potential sort of looming bankruptcy of Cineworld, which is a UK competitor. It's a cinema chain, the second largest cinema chain in the world, and they've obviously got branches all around the world. Their UK business is fine-ish. It's doing all right for now, but its US business is not doing so hot, and they have said that they're seriously considering filing for Chapter 11 bankruptcy protections, which obviously is a worrying insight into how AMC and its actual core business may be doing. As we saw in its earnings a couple of weeks ago, the core business is actually not doing as badly as people thought. There was a ton of blockbusters and stuff that helped its earnings beat. However, its revenue growth is slowing fairly dramatically. But this was what was partly sending AMC stock down. On Monday, people were thinking, well, if Cineworld can't do it, what the hell makes AMC think they can? Cineworld actually said that it was nothing to do with popularity of the cinema, but in fact it was all to do with the fact that Hollywood is basically making really crappy movies these days, which we've had some debate in the office. Some people agree with, some people don't. We also had an interesting debate about the future of cinemas. I don't know if you read our daily email, but we did a little poll about whether people essentially think that cinemas should be over, or if cinemas are actually still quite a cool thing that people like to go to. And as it turns out, fun little fact, people still like cinemas. We had a double the amount of people voted to keep cinemas cool. A lot of people said that it was because of their sense of community, which I thought that was actually really adorable. But cinemas don't seem to be dead just yet. Maybe if Hollywood can just step it up with the bangers, we might be on the track to something good. We're going to stick to the sort of gossipy vibe of that for our next story, which is Twitter. I know it's been a while since we caught up with Elon Musk and his Twitter deal, or potential deal, or almost deal. Still nobody's quite sure. However, there has been a very interesting development that saw a former Twitter exec come out and essentially say that Twitter does not have either the resources nor the motivation to try and figure out whether there are actually, not even whether there are bots. Everybody knows there are bots, but what percentage of Twitter is actually made up of bots? This is obviously a huge deal for Elon Musk, who has been saying that all along. People aren't entirely sure if he's been saying that because he actually is worried about the spam content on Twitter, or if because he's like, shit, 44 billion is a lot of money, and I'm actually not sure I want to spend it on a company whose shares, actually, shall we check those out? Whose shares are not doing so hot. So as you can see, shares dropped 7% yesterday when the whistleblower news came out. Seems to be a little bit of a recovery today, but fairly mild. But yeah, basically this whistleblower was like, Twitter has no idea how many bots are on the platform. They said that there's been a load of security breaches in the past that Twitter has neither addressed nor told people about. They said that Twitter's not keeping up with privacy regulations. It's a whole thing. Obviously, as you can see by this tweet from Parag, CEO Parag, they are denying all the claims, rah. I guess time will tell, because Elon Musk's lawyers actually seem to be wanting to bring this up in court as soon as today, Wednesday. Obviously hoping that will potentially help their case either to get out of the deal altogether, or to actually find out the real hardcore truth about what percentage of Twitter is bots. Now that it's become such a big thing, I'm actually super on the edge of my seat. I really want to know, just because it's been such a massive debate. Everybody has different opinions. I'd actually quite like to know the hardcore truth. So you know what, Elon, off you go. He has also made another move, and he has subpoenaed Jack Dorsey, who was the founder and former CEO of Twitter, and also, coincidentally, one of Elon Musk's very good friends. So he has subpoenaed Jack Dorsey for internal communications, or documents, I suppose, regarding the spam percentage on Twitter. Dorsey has made his allegiance with Musk really, really clear. He has said that he thinks it's the only way forward for Twitter, so it's unlikely it's going to be much of a fight there, and it could end in Twitter being in rather a lot of trouble. Tesla shares, interestingly, are actually up on that news yesterday, up almost 3%. Nobody's entirely sure why, but Tesla has kind of been moving in the opposite direction to Twitter every time some piece of drama comes out about all of this. Twitter goes up and Tesla inches up a little bit. The speculation is that people are actually really not keen for him to buy Twitter, and they're like, nah, can you just keep our CEO over here in our boardroom where he belongs, not spending all of our money on buying Twitter. So yeah, that's that from Tesla. If we're going to round things up there for today, however, we are going to do a little earnings catch up with you. We're going to start with Zoom, who obviously, as you know, was a pandemic darling, was being the operative word. It turns out their whole attempt to switch from a purely sort of work from home tool to an actual enterprise business is going to take a lot longer than anybody thought. Their revenue and earnings showed really slow growth, missed estimates. Stock collapsed. It was a whole thing. Then we have EV startup XPeng, who is Chinese and one of Tesla's main rivals, especially in China, which is a super important region for Tesla. They dropped 10% yesterday after missing on both ends in their earnings, despite actually having a stellar month of production in June. That's largely down to COVID, or the resurgence of COVID rather, earlier this year in China, which led to a bunch of factory shutdowns and obviously people spending less money. Obviously inflation is a problem as well for these super spending EV companies that you have to be like a little bit of a baller to afford. However, they're not doing so well. Speaking of China and lockdowns and regulation, JD.com, which is China's one of the most reputable e-commerce companies in China, actually reported its slowest ever revenue growth for this quarter, largely again down to COVID lockdowns, inflation, sort of penny pinching consumers, etc., etc. We also heard today from two retailers. We heard from Nordstrom, which is like the luxury department store that your wife always wants to drag you to, and they did actually beat earnings and they beat revenue. However, their customer traffic is sinking very, very steadily and not so slowly. We also heard from Macy's, who basically said the same thing. Both companies are feeling pressure on their guidance and lowered their full year forecasts. We have a bunch more earnings this week. However, to be fair, the sort of hump of earnings season is over. We've got some interesting tech companies coming up this week and the beginning of next. We will let you know how all of that goes next week. And until then, remember, you can keep up with all of that and more on our Snaps page or with our email, which is in your inbox every day by 9 a.m. So until we speak next time, have a great week, and always remember to look first and then leap.